Hello and welcome to Property Question Time. I'm your host, Taylor Welch. This is the show where you get to ask your property-related questions to our panel of industry experts. I'm joined today by Gary Pierce, founder of Pure Funding, Heather Kingston, realtor of the Cates Group, and Jerry Allen of Keller Williams Brazos West. Thank you all so much for taking the time to be here with us today.
It's great to be here.
Glad to be here.
Thank you.
Yeah.
Our very first question is for Jerry, and the subject is gifts. The question reads, is it possible to transfer a property to another member of the family as a gift? And are there any financial repercussions for either of the parties?
It's a good question, and the two parts have really two different answers. Yes, you can go ahead and gift it to someone. The age of that person that you gift it to will have some limitations on it. You can gift a property to a spouse, to an unrelated person if you want to. Each of those scenarios is going to have a different impact on the amount of money, the amount of value that you can transfer to that person as far as taxable value is. But say, for instance, you wanted to give a small house to your grandson. You're allowed to do that. But there's a certain dollar limit on that, and beyond that point, you're going to have to pay tax. So that's a really good one to, it's a great thing to do. It's a great way to pass on wealth. You can also do life estates to like a mother or a father. You can let them live in this place. As long as they live, it's still theirs. They can do whatever they want to. And that will have some effects on taxable income too.
Yeah, Jerry, great points. I'll also add that as far as on the loan side, we can also use a gift of equity at closing. So a family member or someone who is wanting to gift a portion of the equity of the home, so whether it's $50,000, as long as there's enough appraised value in the entire deal, they can add that as a gift of equity, which would then bring down the actual cost to the home buyer in that sense. So essentially, if you started out at a $300,000 purchase price and the seller or the family member offers up the gift of equity, then essentially you just take the $50,000 off of that to the seller, or to the buyer, I'm sorry, and then the buyer then is now at a $250,000 purchase price. So that is one thing that you can do from a purchase perspective on the gift of equity as well.
Thank you both. Our next question is for Heather, and the subject is authority to market and sell. The question reads, is it possible for a real estate agent to market a property for sale without the written consent of all parties who own the property or are on the mortgage?
No. Everyone who is on the mortgage or lives in the, even if they're not married, if there's two people in the home, best practice is to have everyone there to sign the listing agreement. So I've run across situations where there might be common law, where people have been living together for a long time, but they're not married. The house is titled in one person's name. Legally, are we required to have both people sign? Probably not. But is it best practice to do that? Yes, because both people that live there and have resided there are on the same page as far as selling the property. So especially if both people are on the mortgage, both people are going to have to sign, no matter what. So it's always two to sell, and it could be one to buy. You know what I mean? For married couples or things like that. But everyone who lives there, best practice, absolutely have everybody sign. And don't market. You can't market anything until all the paperwork is done and ready to go.
Thanks, Heather. Gary, our next question is for you. The subject is credit scores. The question reads, is there a, quote, lowest possible credit score that mortgage companies will consider for a home loan, or does it depend on the value of the loan against the value of the house?
Yeah, so that question's kind of tricky. Depending on the type of loan really is the answer. So government loans will allow you to go lower down the credit spectrum. So for instance, on an FHA loan, most lenders will write down to 580 on the credit score, and will typically take the middle score of the lowest borrower in that sense. So if it's 580 on conventional financing, you're going to probably be in a 620 range on the credit score. So that's more towards a conventional financing, but ideally, there are other products out there that are more aggressive, which would cause more of a higher down payment to go lower in the credit spectrum, but in most cases we try to keep everybody as high as we can in the credit spectrum and work with them with their credit to not take on those higher costs due to the lower credit.
Thank you, Gary. Our next question is open for discussion and debate amongst the panel. The subject is reselling a property, and the question reads, what is the time period allowed on reselling a property after it's been purchased for a conventional loan and also for an FHA?
So there are seasoning requirements with government loans. The FHA, VA, USDA typically have a 210-day seasoning period, meaning you can't either sell or refinance that property at any point until you've met that seasoning requirement. On a conventional financing, that can be essentially sold the next day or refinanced the next day as well. So most government loans come with a seasoning requirement behind that. Tax
implications as well with that question, that go a little bit beyond just the financing portion. But when you've owned a home, if it's an investment home, there could be taxes no matter when you sell it. But if it's your primary residential property, as long as you own the property for 2 years, a single person can, be untaxed with a gain of $250,000, and a married couple could be untaxed for a gain of $500,000. So if you're selling it prior to that, and also found this out this year, if you own the property for less than a year and a day, it's automatic short-term tax. So it is a much, much greater tax burden if you sell that house prior to a year and a day. So at the very least, you always want to own the property for at least a year and a day, and plan for that if you have to. So that's just an interesting.
Right, quick flips. My son does a lot of those type of things, and he had to learn that one the hard way. If you try to go ahead and flip it too quickly, you're going to pay a higher tax burden on the capital gains on it. Capital gains on a investment property is 25% versus on a short term, and it's 15% if you hold it longer than that. So a year and a day, have a happy birthday and save 10%.
Thank you all very much. Don't go anywhere. We'll be right back after the break to answer more of your property-related questions.
Howdy folks, I'm Jerry Allen, Global Realtor with Keller Williams Brazos West. I am your go-to guy for all things real estate. Whether you're looking for a piece of land or a large ranch, first home, next home, dream home, or your last home, I can guide you through the process till we find what you want. It's service like that that's kept me a top area producer for many years now. For more information, visit me online. Remember the name, Jerry Allen. Let's fulfill your next dream together.
Hi, I'm Heather Kingston. Showing land on these ranches that we have out here in Parker County is one of my most favorite things to do. Come on, let's go take a ride. When choosing a buyer's agent, you have to have someone who has geographical competence and a vast knowledge of the area that you were choosing to purchase in. As a listing agent, my focus is to net the most for my sellers with the least amount of risk. That's such an important part of my job. And with a background of photography and videography, I bring everything to the table that we need to market your property to the best of our abilities.
Hi, I'm Gary Pierce with Pure Funding. We're proud to serve Texas and, more importantly, Parker County as your go-to residential and farm and ranch mortgage broker.
That's right. I'm Willis Richardson, and with our passion, products, and process, we'll get you to the closing table on time.
Give us a call or come by and see us. We're located right off the historic square in downtown Weatherford.
Or you can visit us first at our website at www.mypurefunding.com.
Welcome back to Property Question Time. I'm your host, Taylor Welch. I'm joined today by Gary Pierce, founder of Pure Funding, Heather Kingston, realtor of the Cates Group, and Jerry Allen of Keller Williams Brazos West. Thank you all again for taking the time to be here with us today.
Thank you.
The following question is about service rights for Jerry, and our question reads, can someone explain exactly what depth is classified as, quote, service rights? In other words, if I have minerals on or under my land, what depth of the ground is mine?
It's kind of tricky, and the answer is it depends. Surface rights are pretty much what you would think, something that's actually on the surface of the property that you're talking about or that you're about to purchase. Grass, gravel, ponds, trees, and some other things like that. Not the fruit from the trees, but the trees themselves. Those are all on the surface. You would think that the minerals come along with that, but the minerals are subsurface. And that's a whole completely different addendum that has to be filled out. There's one that just deals with minerals, and you can transfer some, part, or all of the mineral rights. But the surface rights typically, I mean, that's what you see is what you've got there. You have rights to go ahead and be able to do whatever you want to with the land that's on the surface of the property. Sometimes the tree roots go quite deep. And if you want to go ahead and cut down a tree, well, you have that right, but you might tick off the owner if you're leasing it from them. If you're buying it, it's your property. You can do whatever you like with it to that point. Minerals, although the surface rights usually typically extend about 2 feet below the surface. But minerals go to the center of the earth. So from whatever you have, it goes all the way down to the center of the earth.
Interestingly, I read that the average depth that oil and gas is drilled is about 6,000 feet. So a lot of people think, oh, it's just right below, they're going to hit a pipeline or something like that. But, it's always good to check. If there's any pipelines running through the property, definitely check what kind of fluids are running through those pipelines, how deep they are, what impact they could have on your property. But also, a lot of times they're really, really deep. I mean, 6,000 feet is, what, a mile under the ground or so?
That's center of the earth.
it's pretty, it can be pretty deep. It could be 2 feet under the ground. It could be a mile under the ground. So it's an interesting thing.
Quick question then, too. So obviously water is a super important issue right now in Parker County especially, right? So how does, in your experience with your contracts, is water coming up as like in Colorado, New Mexico, places like that? It's a very important piece. Are you seeing that come up yet as we're kind of going? We just came through it. We're in a drought essentially. So are you all seeing any of that in your contracts?
Oh yeah. Whenever you have a pond on a property, it's automatically much more valuable. A lot of people have what they call wet weather creeks, which means when it rains, there's a creek. Okay, that's kind of nice, but when it doesn't rain, you have a ditch.
Yeah.
So, but it does add value to the property if you have 1 or 2 more tanks, even if they're not always full.
Right.
If you have nothing, you have nothing.
But the aquifer, I believe, are you asking more about the aquifer that people are tapping into with their wells?
Yeah.
So that is regulated by the Groundwater Conservation District. So they have, and in our area, it's called the Upper Trinity Groundwater Conservation District. So they're the people that are in charge of the wells. They're the people that are in charge of making sure the wells are not too close together. Each well has to be I think a minimum of 100 to 150 feet apart from each other. So it's really important for that conservation district to know where all the wells are. A lot of people are out there saying, well, I don't want them to know about my well because I don't want them to restrict my water use. There's been no conversation for them to do that. I remember a little bit ago, people were saying, oh, they're going to put meters on the wells, but that actually was never a conversation that they were having. And the reason it's important for them to know is because they can protect your well, making sure that all other wells around you are a certain distance away from you. So it's regulated, but it's not really part of our contracts.
Right. Okay.
So.
And it is controversial, very controversial, because I know at least down in Hood County, they were trying to go ahead and make it where you had to have 5 acres to be able to have a well on it.
Sure.
They were not able to pass that, so it stayed at 2 acres. And even 2 acres is a little bit restrictive, but.
Thank you all for your response on this. Our next question is directed to Gary. The question reads, if there is no residential building on a farm or ranch, what kind of loan could be used to purchase the property?
So on typical ag loans or agriculture properties, it's simply an agriculture loan. We would write through one of the farm credit products that we have. Where it gets a little tricky is where in our area, in like a place like mine, or where you have acreage with a home, it gets a little tricky because a bank or a lender may require the home to be a certain value of the property. So they don't, a lot of banks, a lot of lenders don't like to get into that ag production type property, and then it becomes more of a kind of a quote unquote commercial entity versus a residential. So in the case of when we're kind of evaluating a property, what we look at is what's the best use of the property, and not is it ag or is it residential, one way or the other. But typically it's the best use. And in our area, a lot of times the best use is residential. Even if it has 25 or 30 acres, you're probably not going to have a very profitable business on 25 or 30 acres trying to grow hay, let's say, for instance. So.
Thanks, Gary. Our next question is for Heather, and it is simply, please explain what a 1031 exchange is.
All right, this is going to be maybe a little bit of a longer answer because it's kind of a complicated thing. And there's many different facets, and by no means am I an expert in this, but a 1031 is a deal that the government set up to basically encourage people to continue investing in real estate. If I was an investor and I bought 3 homes and I sold those 3 homes to buy 6 more homes, but I had to pay capital gains on that, on all 3 homes that I purchased, it would really inhibit me from purchasing as much as I maybe want to. So the government and the tax code set up something called a 1031 exchange, which is essentially deferring when you pay the taxes on your gains. So if I buy a $300,000 property cash, and I go to sell it, for $500,000, you've got a $200,000 gain. And if I get that $500,000, I can then put it into an account that is being held by a 1031 exchange company, because you really have to use a 1031 exchange company. They will protect your funds and hold on to them so they never hit my account. And then when you purchase the next property, and there's a lot of rules, you have 6 months to identify and close. Well, you actually have 90 days to identify 3 properties, and then 6 months to close on them. So there's a lot of rules, and the 1031 people will take you through it, but it protects you from having to pay your taxes. And the cost is very minimal, but the most important thing, because most of these 1031s, you don't have to be licensed, bonded, insured, registered through the state of Texas to do this. And so there have been 1031 exchange companies out there that are fly-by-night that take the money and run. So you have to make sure that you are using a legitimate company that's been doing it for years and years and years and has a really good reputation for it. Because you're literally giving all your money to someone to hold it for you, to then give it back to you in 6 months. So yeah, it's a pretty great deal.
It is. And you can actually do it at the closing table. If you're faced with selling a property and you go, oh my gosh, I'm gonna have to pay a lot of money on tax, what do I do? There are some that you can use, and you can call them while you're at the closing table. It'll delay closing about an hour, but they will fix up your 1031 and fix it up for you and send the money to them.
You do have to identify it, that you are doing it prior to signing the paperwork, 100%. Right. You can't go back and go, oh, I meant to do this. Yeah. I meant to not have to pay all these taxes, so.
Thank you both. Our next question is open for discussion amongst the panel, and the subject is chattel mortgages. The question reads, what is the meaning of a chattel in the context of a chattel mortgage?
The chattel mortgage is set up specifically for homes that are mobile, so manufactured homes that are not permanently attached to a property. So most lenders are going to, if they're going to lend on a manufactured home or a mobile home, they're going to do it with the idea that the property is actually owned by the actual client. So this property, in a sense, would be, or this loan would be used for a mobile home that is not permanently attached. So in the instance of a mobile home park, you're leasing the spot. You own through the mortgage, you own the manufactured home or the mobile home, and that way you can move it to another property if you wanted to, but it allows for the financing of a mobile structure. Traditional lending is always geared more towards a permanent structure on the property.
So we're probably seeing this a lot more with these tiny homes, because tiny homes are, they're more of a stick and brick, but they're also on that mobile structure that can be moved around. And traditionally, if you're buying a mobile home on land, if it doesn't have permanent tie downs set to the federal and state standards, the bank is not going to give it any value when you're buying a home. So it has to be permanently attached for a regular loan. But for these tiny homes, it's a pretty cool way, and it's probably a somewhat of a newer product, because the tiny homes are kind of a new thing that are really cool and out there, and it's hard to get funding on things like that.
It is definitely what I would consider a niche product. A lot of, like I said, most traditional lenders don't lend on those products, but there are niche companies out there that definitely provide that kind of financing, and they're great products for those folks that are looking at the kind of the tiny home experience.
Do you have any idea the interest rate on those? Would those be a higher interest rate than market value, or?
Typically, they're going to be higher. Anything, when you're thinking about rates, anything that's out of the ordinary, when I say out of the ordinary, non-traditional, non-residential, is going to come with a little bit higher rate, because the inherent risk to the lender is a little bit higher, so they're going to charge a little bit extra on that.
And also the portable buildings that you see a lot of, not like tough sheds and things of that nature that are not built on a slab and permanently attached. The chattel is something that is movable, just by the definition. So when you have a storage building or a small barn or something like that that is just sitting on the property, that's something that can be moved. It doesn't necessarily, like if you sell that property, it doesn't necessarily transfer with that. So that may not be included in the mortgage that Gary's going to be doing.
Yeah, that we run across that a lot with storage buildings that are on the back of the property. That's one of our jobs as realtors, is to make sure, hey, is there a loan on that? Is that loan has to be paid off prior to close for it to stay on the property. You can't sell a property with an existing loan staying on there. Yeah, it's a big mistake if that happens.
That's where the title folks come in, and once you get the title commitment, and they ask for some more feedback on that, and then you got to figure out what to do with that loan to get it off the property.
Right, because sometimes you can get these small workshops and stuff on a rent to own type thing, and they may not be anywhere near paid off, and people will come in, a buyer will think, oh, that's going to be part of my property, great, I'll offer this price. Then they find out, no, this guy owes $25,000 on that. Do you still want it? It's going to cost you $25,000 cash. Gary, you want to loan it to me? It's like, sorry guy, can't touch that. It can kill a deal.
Yeah.
Thank you all for your answers and response on this. Sadly, that is all the time we have for today, but please keep your questions coming. You can send those in via our website, PAX180.com, or by emailing pqt@paxtelevision.com. And my special thanks today goes to our panel of industry experts. Thank you again so much for taking the time to be with us today.
Thank you.
And thank you for watching Property Question Time with me, Taylor Welch, and we'll see you next time.